Hi, I'm Jerry Brockman, Chief Investment Officer at First American Trust. Let's talk about rates. Why today? We've seen the 10-year Treasury yield, or the rate paid on that bond, breach 5% for the first time in over 16 years earlier this week. Why are rates so important? Well, let's look a little bit back. Earlier this year, we had inflation over 9%. And the Fed looked at its playbook and realized, well, we know how to combat inflation. Let's raise rates. And so we've seen that happen both on the front end, the Fed funds rate, as well as the longer end, the 10-year rate. When we look at how that affects our economy, everything that's financed is basically that Treasury rate or the Fed funds rate plus 3%. So when we look at the prime rate, that's normally 3% higher than that base rate. When you buy a car or you lease a car, that rate is imputed in that cost and would determine your monthly car payment. Same for your mortgage payment. So when we went 2 years ago from a 3.25% 30-year fixed mortgage to today about 8.5%, that's twice the monthly payment for that same value of house that you can afford. So again, that's why the economy will slow, and we've made a lot of progress. Today, inflation is about 3.2%, so very close to the 2 to 3% range that the Fed is comfortable with. When we look at the bond market, bonds get immediately priced for that effect. So again, the price you would pay for a 2% yielding bond versus a 5% yielding bond, obviously you want to pay less for that 2% yielding bond. On the stock market as well as the real estate market, it takes longer for those values to adjust. So going forward, the Fed has indicated that they're close to that 2 to 3% range of inflation and close to the end of their rate hiking cycle. When that will exactly happen will depend on the numbers, but we expect that probably to finish in the next 3 months or so. As we look forward for rate expectations a year from now, we do see that the market expects the Fed to have paused and start cutting rates, and that forward rate projection will provide some relief going forward. But what has already adjusted again is the bond market. So looking forward as to where we would like to invest, we'd rather invest in places that have already adjusted in price than in places such as real estate or equity markets that have yet to fully adjust for that price. So again, this is a brief recap today. Thanks for joining us.